Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Dan Zwirn from Arena Investors. He's got an updated approach to deep value that is absolutely fascinating. It's a modern day Ben Graham approach to markets right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Arena operates businesses as well. So how do you characterize Arena as an investor?
Well, we just characterize it as an investor. We are as comfortable as traders, as lenders and investors, as well as operators and merchants. And when you really look at, who are the best true value investors, they are going back, many decades. It's people who are as comfortable with security as they are with operating, right? And you look at today's world and you think about a Glencore or a Cargill, or you think about some of the large Hongs, right, in Hong Kong, like Chung Kong Holdings of Li Ka-shing and other folks like that. Or you look at a Bolloré or an Arnaud, or folks in Europe. They're trading, they're buying and selling, and they're owning and operating. And so it's just another way to extract value. So in our case, we have the ability, we own 10 or 12 businesses now where either opportunistically we had a chance to buy them at levels we'd lend to them and own them for nothing, or in situations where we had to, we had a counterparty that couldn't live up to its terms. And so we ended up owning the enterprise. And so there's opportunity there too, right? There's another opportunity to allocate capital and look at the next marginal, at the margin, the next ROIC that makes sense, whether it's buying another security, doing another trade, or plowing capital into an enterprise that's well managed and well aligned with thoughtful, skilled planning involved in terms of operating those enterprises. And so when you see Buffett, or you see again Li Ka-shing, or you see these folks, it's all one thing. It's the investment of that marginal dollar at its most optimized return per unit of risk, and being creative as an owner merchant can be helpful. And then also on the other side, being creative in terms of the capital you manage, which is a driver of the merger of the skills of managing obligations in insurance and investing, right? And you see a lot of folks thinking about, like Buffett did decades ago, and like Henry Singleton at Teledyne did decades ago. Maybe there's pools of capital that I can use to do my merchanting and trading and investing that really optimize that kind of fully that full capability I have to optimize return.
So how do you think about Arena? Is it as a hedge fund, or is it, you wouldn't necessarily define it that way? You think about it in much more broad terms, even including something like Li Ka-shing's. I always thought of Li Ka-shing as more of a trader, but they were investing as well.
If you any student of value investing should look at Chung Kong Holdings and Hutchison Whampoa. What's incredibly interesting about that, as it is with Berkshire, is not any one trade or any one holding, right? It's the structure itself, right? Buffett has built, now there could be caps in terms of the sheer size of it, but fundamentally he built a money machine. He built unbelievably cheap cost of capital that put him in a position not to have to reach for the last dollar, to just look for a great moated franchise delivering a 10% unlevered yield. Put those two together, and it's a money-making compounding machine, right? And Li Ka-shing has done the same thing, and several other people have done similar things, whether it's Koch Industries or, again, Cargill or others. And it's the structure itself. And so that's when I talk about thinking about Arena and putting that value investing lens on Arena. Do you want to own Arena as a stock, so to speak, right? As a business? Does it have a moated franchise? And has it created an ability to kind of create perpetual compounding value? That's what we aspire to. Certainly we are not that, but we certainly aspire to such things.
So how do you achieve that structure, or what's the key element of the structure? It's the cheap financing, and then on the investment side, you're looking for however you characterize the opportunity, 10% unlevered free cash flow.
It's really three things, right? It's complete flexibility of mandate, so you're then not forced into a moral hazard corner. It is very proprietary, efficiently priced, hyper-aligned sourcing of opportunity, and it's the creation of underlying infrastructure and capital formation that is scalable and hyper efficiently operated. And that means things like our people, our processes, our IT, how that works in order to kind of make it all come together as an enterprise.
When did you establish Arena?
2015.
And before Arena, what was your focus as an investor?
Before and throughout Arena, it's always really been the same, which is really the equivalent of deep value investing.
Yes, your structured credit. Structured convertibles. Is that fair? What is that for the folks who perhaps don't know?
Well, I think just to step back, deep value is deep value. And whether that's in a company or a piece of property or a structured finance asset or securities. And how you create that is just a matter of structure. And so whether that's a loan or buying an existing loan or a bond or a convert, or whether it's public or whether it's private, those are all just tools in order to kind of extract and optimize return per unit of risk within any given situation. So structured private convertibles are an example of something that's interesting that we do with public companies around the world that benefit from, frankly, situations that are more volatile, where the companies are the opposite of what you would look for as a Buffett-style value investor. They may not have moats. They are capital intensive. There's high volatility. There's lots of things out of your control. But in the case of the value investment going on there is what we're doing. So as an example, those kind of companies might be sub 200 or 300 million market cap, may not have otherwise available access to liquidity, right? And so we act as the casino, not the gambler, so to speak. And someone says, well, I have this stock that's trading at a very, with decent volume. And so we'll say, okay, we'll write you a convertible that converts actually at a discount to your trailing number of days trading pattern, right? And so we're kind of issued day one. We've created a cigar butt, so to speak, right? We've created a pretty darn certain spread, and we're also given quite a few out of the money call options, warrants of various sorts along with that. They then take those proceeds from the original issue that we've done, and they enhance their mine, they enhance their pharmaceutical project, they enhance their digital online media oriented, whatever it's going to be. And if that works out, great for them. If it doesn't work out, not great for them. But in either case, we're going to make money. And so we've turned in that situation what otherwise would be a difficult to invest in situation into a Ben Graham style deep value, heads I win, tails you lose situation.
Do you view these as, is it credit or is it equity or is it quasi sort of, it's a blend of both? How do you think about them?
Well, I think a lot of folks in investing think about a couple things. Think about debt and equity as a binary, when in fact it's really a continuum. a risk reward. And furthermore, they sometimes make the mistake that of conflating what something is labeled with the risk they're taking. So we see plenty of situations where people who have a thing called a piece of debt, but are taking equity risk. And conversely, we see plenty of situations where we might own a preferred equity or even a common equity where we're very much taking a debt risk, right? So we only look at the underlying substance. And in fact, the fact that conflation occurs is an opportunity for kind of arbitrage profits. So in the case of the structured private convertible, before we've converted, we're actually senior to all the equity that's there, right? The second that we do convert, some or all of that, we own equity briefly, but subject to a locked-in spread, right? And then furthermore, we own options, right, for which we've paid no consideration, right, which are just kind of additional ups. So when you look at the kind of payout pattern of what I just described, what it really does is get you an equity or more than equity type return with a debt or less than debt type risk.
What does a typical borrower, why do they come to see you rather than, say, going to a bank, given that you're going to be requiring more onerous terms and some equity upside participation potentially, plus on top of that warrants and options? What is it that Arena offers that a bank can't do, or a secured lender can't do?
Yeah. Well, we frequently run into that question because sometimes potential investors of ours say, I don't understand what that is, and I don't know why they would do that. And, frankly, at some point that that really dovetails into the topic of the degree to which your investment philosophy, coheres with your entire philosophy of how things work and how people operate. And, as a general matter, participants in markets cumulatively kind of act in the same way wherever they are and whatever status or strata they occupy, and whatever time they're involved, right? And as a general matter, people like more than they want, more than they have, right? From the smallest subprime individual customer to the biggest, super high net worth person, right? And so we tend to find ourselves in what's common about everything we do is that we're dealing with folks who need the money. They don't want the money, right? Because if you just kind of want the money, well, then you've got all day long, you've got all the time you need, and you can wait 6 months for the bank to decide they like the color of your eyes or whatever they do, right? They're not swift, to say the least, not only in both senses of that term. And so we see folks who have this need, and sometimes it's offensive oriented, like I need to do this because I think I can make a lot of money, or sometimes it's defensive, like I'm protecting my position. But that starts to create a process opportunity versus a value risk-taking opportunity for us, right? And so sometimes that's because it's geographic, right? So no one wants to do Greece or Italy or Puerto Rico. It depends on the country, right? And these days, we're looking at things like Turkey and the Ukraine and wherever, as we say, we look at every house that's on fire and we stay in some. It could be industry, right? No one wants to do oil and gas. No one, people have been burned by trade finance or things of that sort. Again, they're running the other way and we're running toward it because there's always this overshooting. And then finally, there's these individual situations where someone thinks they have a wonderful transaction, but it has this really tight time frame they need to operate within, or otherwise they're under duress in some way and they need assistance and they're willing to pay a premium not for someone to take excess value risk, but to work faster, work smarter, provide solutions that others can't. And furthermore, the evolution of the alternative investment space has kind of helped that along for us, because if you really map out that ecosystem today, there's kind of a systematic Peter principle going on, where which, as I'm sure you're aware, Peter principle meaning rising to the level of your incompetence, right? And so there are myriad investors out there filled with really smart people who are managing unbelievably large amounts of money because they were good at managing that much less money, right? So why not have that much more money? And so it's really created a competitive umbrella under which we operate, whereby a lot of those great smart people really can't get out of bed for less than $100 million check. And so that leaves a big world of have-nots out there that need to be addressed. And on the lower bound of the investment universe, then there's really people who are basically hyper-specialized, which one, means that they can only do relatively few things, and almost ironically are inclined frequently to take more risk than otherwise they should, because they're susceptible to the old hammer that only sees nails risk of only knowing how to do a very limited set of things. And so we operate in that big middle that's getting bigger every day as that competitive umbrella rises every day. And even at our current 2.2 billion, we have the kind of next step up where people are tending to compete on the price of capital is way off in the horizon for us.
There's a great comment in one of the institutional investor profiles on you where you said something like you don't like to rely on the weighing machine of the market. You have two options. You either get repaid or you take control. Can you perhaps talk through that idea a little bit?
Yeah, I think that dovetails a bit with my comment regarding our being truly, Ben Graham style deep value investors, which is that for better or worse, folks who have been focused on value have tended, particularly recently, to kind of start to bring hope into the equation, right? And hope, we all know, is not a strategy. And so they start debating, value versus growth, and oh, woe is me, won't somebody recognize my 5 times cash flow business and buy it from me for 6 times? That's very uninteresting to us, and so structure allows us to not just identify value, but to extract value, right? And so that means effectively we bring the weighing machine to the party, right? And so when you have a maturity, it's time for us to assess the value, put it on the counter, and either you're going to buy back your asset or be able to refinance, or we're going to liberate that asset from you and monetize it. And so structure allows you to almost recreate the dynamic that Ben Graham did in these nets, where you had, as an example, a liquidating enterprise, which already said, look, we're liquidating, right? So we have the event. There's no hope required. We think we're going to get, 10 to 12. It's selling at 8. It's going to occur over a particular time frame, right? And so the weighing machine is present. But in so much more of what is referred to as value, there's simply no catalyst, no hard catalyst. And then, people then seek to cure that through activism. From our perspective, we've never been big fans of that. Activism in many instances is just kind of saying please louder, as opposed to simply dictating the answer, right? And so structure allows us not to say please softly or loudly. It's just going to happen, right? And so that's whether that's in a loan structure or buying a loan or creating a convertible or whatever, we keep things very tight in terms of duration, right? Because duration has a cost, and it's frequently not compensated for in this market, right? Because the longer I'm involved, the more puts to the world I'm short, right? So I need to get compensated for that, and that's not happening much, right? So we're going to keep duration tight, we're going to keep structure tight, we're going to isolate value, and then we're going to be able to extract it. And so that notion of not not being in a hope position is very important to us.
I read, I'm not sure whether it's an average or whether it's the outlier, but you like duration around 2 years.
Yeah, look, I think we like to think that we are as agnostic as it gets, right? So we're equally comfortable in a 1-day trade, a 2-year trade, or a 5-year trade, right? Or more, right? But it goes to what I just said before, which is in this market, we simply don't see duration compensated for. So therefore, we're not going to take it. But duration is a commodity like anything else. And if someone's willing to pay, then we're willing to consider it. Furthermore, I think we habitually delineate the duration of our principal versus anything else, right? So we also like to say that we're as patient as we're unbelievably patient once we're playing with the house's money. And so if my bait's out of something, I can wait around all day. And so, that's just a question of discipline. And in this market, I think you've got to be short because the market won't pay you to be long.
When you say you're getting your basis back, is that you're getting the principal back and then you're retaining the options or the warrants? Is that the
optionality, however that might be defined? That can come in lots of different forms, right? That could be it could be warrants, it could be royalties, but it could be things like in several instances, we have found situations where there was a process wrinkle occurring, and it appeared to us like the value was such that if we just bought the asset and the kind of process risk was removed from it, it would be readily financeable. And so we bought the thing, and then within 90 to 120 days, borrowed our entire bait out of it, right, and owned it for nothing, right? And so that's another way to kind of create that. And so when you have a free-flowing mandate and are completely agnostic as to the instruments involved, right, and have a decent assessment of intrinsic value, you can kind of put those tools together and put yourself in situations where you own a lot of free ups.
So you're a special situation investor where you're sort of creating your own catalyst, and you have a very wide remit for how you execute that idea. How do you track down the investments? How do you identify them? Because these aren't screenable opportunities, presumably.
That's right, they're not. Well, first, we know there's a lot of them out there, right? Because there's while capital is as cheap as it has ever been, these days capital pays a premium for simplicity and homogeneity, right? And so we talk about this dichotomy between the haves and the have-nots, and you definitely got to turn over a lot of rocks, right? And so again, thinking of putting the lens upon our own enterprise and saying, well, how would Buffett or Ben Graham view our enterprise? Do we have a franchise that's moated, and is it sustainable? And how do we gain edge? And is it leverageable? Is there operating leverage implicit in it? Leads us toward the notion of what we call joint ventures, right? Where we say, okay, we have among our investment teams people with domain capability that's monetizable throughout a cycle. But as part of those domains, there are innumerable things where there are particular wrinkles or particular opportunities, either by sourcing, analytical, or servicing capabilities, that likely aren't going to be monetizable throughout a cycle, but can be very episodically compelling. So we will create joint ventures that are variable cost efficient to us, and where our partners are hyper aligned with our interests, i.e. they're writing checks and we're sharing proceeds in a way that can make them very, very happy when we're pretty darn happy, and very sad when we're a little sad. So we effectively amp the ups and downs for them, which effectively incentivizes great conviction on their part or not. And we control all the investment decisions up front and along the way, and we control all the cash through our asset surveillance unit, Quester Advisors. But that allows us to kind of really open up the funnel, right? Because instead of a firm with we're now 65, 70 people going to 100, but we have, 200 or 300 additional folks who wake up every day with their eye out for things that make sense on which to partner with us. And so that puts us in a position where we might be pouring through, 10,000+ things a year to find, 70 to 100 things a year. Now, we know that from talking to potential investors, unfortunately, a lot of people say that. And they're really kind of mowing through investment banker books and such, right? And when we look at opportunities, we look at them raw, right? If it already has a blue book in a good font, we're probably not the guy. And so we talk to people and say, we don't even need a deal. Just if you know two people who know how to do a thing really well and they're willing to kind of cash up their personal net worth to kind of go do it, I want to hear what they want to do, right? And what their edge is about. And so that allows us to have this enormous pipeline that we really can break into different permutations of industry, product, and geography. And it's like having being a fisherman with nets. We don't know what fish are going to be in what net. Every day, we pull them up and see what's in there. And when you see such a broad swath of industry, product, and geography, what you then tend to see is great dispersion when thinking through return punitive risk. So we see things that are kind of obviously good on a risk reward basis and really things we want to run at. We also see things that are obviously bad. And we tend to see things that are obviously bad before the kind of warning bell has come on those, right? And so in certain instances, we say, well, can we create cheap put optionality, or can we, be short this in some way asymmetrically to take advantage of this kind of really awful return per unit of risk we see, right?
Can you give an example of that? Can you give an example of that of both of those sides, perhaps how you're identifying a better than average opportunity and how you're identifying something that you'd rather write the put on or buy the put on?
Sure. So as an example, we have a wonderful business in Korea doing a form of structured private convertible, kind of called share-backed lending, that's very interesting and lucrative. And that's a small world of folks. And, we've been operating there for many, many years. And, there's pretty good risk reward built into these structures of these emerging companies there that are pretty favorable. And we see it over and over again as an example. On the other side, we see things like what's going on in leverage loans, right? Which are fueled by the fact that no one's taking the risk because they're finding their way into CLOs, the right side of the balance sheets of which are way too tight and are effectively pushing risk into other people of various sorts. And we say, how do you create cheap put optionality there? And that could come from things like different combinations of securities that you're long or short to create effectively a carry or that's at least neutral, that allows you to wait for something to explode, either idiosyncratically or kind of on a larger semi-systematic basis. It could mean things like some of where you see sovereigns where the actual intrinsic state of their economic affairs are horrid, but they're able to borrow at negative rates, like certain parts of Southern Europe, right? And so you say, well, how do how is that not a value trap, right? How is it kind of silly and positioned to kind of continue to be silly? Well, then the challenge is not only is it silly, but how do I create asymmetry there so I'm not in a position where, as they say, the market can be irrational longer than you can be solvent, right? And so setting those things up to create optionality on the put side versus the call side is something we think about.
The last 12 plus months have been volatile. We've had a huge drawdown, and then we've had this absolute flood of liquidity. How do you navigate something like that? And what does your opportunity set look like as you go through that big drop and then the flood of liquidity on the other side?
Well, I think we start with an analysis of what are the secular changes that came into play with COVID. When you contrast that with, 08 or 0102 or 98 or 94, et cetera. And it is 2020 is rare, and it's not that it's never happened, but this much ubiquity of availability of liquidity, this much agreement among sovereigns, both in their monetary authorities and the governments themselves, to kind of act a certain way in response to the world, really hasn't happened in centuries, and so that's interesting. You're seeing basically all of the world's monetary authorities and governments comfortable, utterly debasing their currencies, right? And ultimately, whether you believe it or not, the notion of cryptocurrency, as an example, is really like a voting machine on how much we all think badly of all of our developed market currencies, right? So we may differ on the degree to which we think some of those currencies will be legitimized or legitimate, but that vote against the intrinsic value of dollars, euros, yen, et cetera, is pretty strong, and there's a reason for it. And so we have this massive excess liquidity, this massive over response, the massive overreach of government, and that has never failed to create volatility and havoc, just never, right? And so whether you look at the Great Society and Vietnam War era of Johnson, you go back to pre-World War II Roosevelt, you go back to the implementation of the income tax in Wilson, and even the desire for it in Cleveland and so forth, or even in the UK with the disaster of the Wilson government, right? Every time government reaches out and just gets itself involved in things, it grotesquely misallocates capital, creates all kinds of different arbitrage opportunities and havoc, right? And we think that is the backdrop. And again, we're not macro investors. I don't have a view as to the timing of any of these things, but it's demonstrably bad. And so we kind of like where we sit in that regard, because, we're kind of neutral to all of this, right? Other than we need change. We need people to really dislike something or really like something, because either way they overdo it, right? And this kind of situation leads to lots of overdoing and underdoing of things, right? And it creates opportunity for us. And what we've seen is it's happening sequentially, right? So different pockets of opportunity are coming available, right? And so you saw that with travel related things, and you're seeing that with business related accommodations and travel and things of that sort. You're seeing people who are amending, extending, and pretending. You're seeing throughout the credit markets access to liquidity in the absence of solvency. So always the greater fool there to take you out of your problem. The moral hazard bubble growing and growing. The complete unwillingness of monetary authorities to acknowledge the inflation they're creating, right? And so that's going to open up more and more, and particularly as COVID is solved, there's a ton of different actors in the market who have said, well, if only COVID was over, all would be well, right? Never mind the tremendous secular changes in the way we all live and do business that will create really a lot of different secular changes that will have to be responded to. So we're going to be beneficiaries of those who hit the wall. And we've also been beneficiaries of those who are taking advantage and playing offense and building and doing and creating things that will benefit from this new existence that we have. So lots and lots to do, lots of change coming.
I know you just said that you're not a macro guy and you don't have any idea as to the timing, but let me ask you anyway. You're clearly a student of history of the markets. How do you see something like that potentially playing out? And is it months? Is it years? Is it decades? How long does it sort of take for the toll to be paid?
Well, part of it depends on how much of this stuff sticks. I think there's a lot of, in the US, which is always the driver, or not always, but certainly is going to be a major component of what happens. There's a lot of reasons to think that this kind of mini boomlet of post-COVID will carry the Democrats through the midterms, which will create all the more likelihood that a lot of this stuff sticks. And historically, no matter if a conservative government later comes in, once a nation state's government gets its hands on more power and more resources and more dollars, it's like taking steak out of the jaws of a lion, right? And so it'll be very hard to unwind all of that kind of bad policy, no matter who comes in. And so at that point, is that by 24 where you start to see that? It could be 25. Part of the issue is you look at Japan, right? And what they've said is, look, it's never going to end. We're going to take the problem we created and we're going to just smooth it out into the perpetual future, right? By always being there with more liquidity, ever and ever and ever. And so you could very much have this kind of malaise effect that just kind of stretches out. In the US, that was late 60s to early 80s as an example. It took years for and that was when you look at the Wilson government in the UK, it took years for that to kind of, and a lot of pain, right, to kind of for that to be shaken off of the UK. And so could you start to see effects of this in 24, 25? Certainly could. Timing these, not many things are harder than being a successful macro investor, and I'm certainly not one. We just want to be there. Again, we want to be the impartial arbiters that are, again, the casino, not the gambler, and be a beneficiary of the volatility that will be created from it.
That period from the late 60s through to the early 80s was one where the stock market really did nothing, with a whole lot of volatility in the interim. And since the 80s, we've really had this extraordinary bull market it's had its ups and downs, but it's also we're at all-time highs now. Do you see there's some sort of Minsky moment coming? Is there something likely in that?
Well, I think when you look at historically, there are these moments, and they're triggered by something we all don't think as likely, because if it doesn't surprise, it doesn't kind of shock the market into acting. When WorldCom announced its fraud, the first thought for us was, thank goodness we're not in that, right? Because there were people in near-term revolver at 92 that it was trading at 10, and then there was very quickly a tidal wave of leverage loans and credit, coming over the sell-side transom. Certainly these days, you look at someone smart who thinks about left tail events like a Byron Wien, and you think about things like China invading Taiwan tomorrow, right? Because if they decide to do that, no one's going to stop them. And that could be shocking, or it could be so overwhelming and over in 3 days that maybe it won't, right? Or certainly what we've seen is, what's interesting is we've seen wherever there's even a little bit of a shake in the markets, Jerome Powell and other monetary authorities and governments themselves they don't even let the let the stock market move down a little bit before they come out and say, we're going to do everything, it's going to be okay, and please don't. So it's got to really be a shocking thing that's going to break through that kind of stuff. But for that, I think you'll see there's a lot of chances the market will move up, at least in nominal terms, right? Like, yes, the S&P is X, but it's X denominated in these things whose value is declining, by the month.
There was a question yesterday in Presser to Jerome Powell. I thought it was revealing one. I thought it was a good one. One of the journalists asked, we've got the property market is white hot at the moment, residential property, very, very hot. And yet the Fed continues to buy $40 billion of mortgage-backed securities every month. What's going on? Help us connect the dots. And he sort of gave this very evasive answer that I thought was revealing in the sense that they're really they're managing to something else. They're managing it, and possibly it's the stock market, but it's not. They're not managing that individual risk at all. They're not thinking about that one at all. Do you have any thoughts on what the Fed is doing?
Well, certainly in the middle of March 2020, we saw them basically communicate that they weren't going to let investment grade credit go down. And why would that be? Well, there's huge exposure, on the part of banks, insurance companies, pensions, massive exposure. I would suspect that, let's say you take the average life insurance company that has $1 of equity for every $10 of assets, and 85% of its assets need to be in investment grade credit, right? And that investment grade credit might have been making a couple percent with a 4-year duration, right? And if that spreads out 200 basis points, the reduction in the equity of the entirety of the life insurance business is massive, right? Massive. And so, as one example, right? So you can see where unfortunately, because of the bubble that was blown up in the 12 years between 2008 and 2020, there is nowhere to go. There's nowhere to go, right? Other than to just dig it deeper or make the bubble bigger. And so, again, people's lust for residential real estate is no different than their lust for cryptocurrency or anything other than that which is denominated in USD, right? Particularly among even retail, where I've had people say, well, as a retail investor, what should I do? What should I buy? I'm like, well, I would buy, I'd scrape together enough dollars to borrow super cheap and buy a 4-unit multifamily apartment, right? Because there you have an appreciating asset that's creating yield, right? That's going to, that effectively mitigates the damage that this activity is doing to all people who responsibly save, right? But it's remarkable how willing the monetary authorities are to kind of keep this going. And it's unfortunate. It takes a lot of pluck to be Volcker 1.0, right? And say, look, this is insane, but if we're going to do things right for the long term, instead of just pushing problems into the future, here's what we got to do.
What is the what's the end point to that? It clearly requires some sort of political will to do it, which just there'd be absolutely no reason why any government globally would do that when every other government is printing, because I assume that the moment that you do that, you're going to see a collapse in asset values in your own economy. So how does it resolve itself?
Well, if there's overwhelming political will, it's just to do the wrong thing, because that's good for getting votes, right? There's a wonderful book on Weimar Germany that in the preface of which quotes Keynes, in turn quoting Lenin, basically saying the greatest way to undermine capitalism is to debase the currency, right? And then Keynes saying, and the greatest thing about that strategy is not one man in 1,000 understands that it's happening, And so when any kind of, extreme borrower gets way out over his or her skis, if he or she can pay back in depreciated currency, that's the greatest, right? And so if you're a politician looking to the next election, or a monetary mandarin looking to, boost your resume, right? This is great. Just kind of keep printing, 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 printing. And then, hopefully you're retired, or you've moved from the legislature to the governor, or the governor to the next, or back to the private sector, and it's somebody else's problem.
Given that, it sounds to me like you think that there's a great deal of risk out there. There's a very visible reef underneath these waves. How do you protect your investors when you were referring earlier to seeking diversification across geographic? I'm sorry, I missed the other two, but
product and industry, product and geography.
Can you just explain that a little bit? And is that the way that does that assist with the protection?
Well, there's two key parts of protection. One is that diversity, and it's like, let's say you're a property and casualty insurer, right? You don't want to write just a huge amount of risk for Japanese earthquake, right? You want to do earthquake, and you want to do tsunami, and you want to do all kinds of other different types of, bad weather things, and then you want to do them all over the planet, right? You want to spread out, right? Because anything can happen anywhere, right? So I want to have as much diversity, not just by number of positions, but by the lack of correlation amongst that which happens to each of those permutations, the notion of orthogonality, right? As much orthogonality as possible. And so that helps us, shield ourselves from those kind of lightning strikes that happen, so that we're not then, on the next day's Wall Street Journal talking about woe was me. It was a 100 years flood or whatever, perfect storm, right? The only thing that is sure about perfect storms is they keep happening, right? So let's spread out and not use that as an excuse. Separately, there's this notion of structure, and in this case, subordination, right? So again, no matter what instrument I'm in, whether it's a piece of debt or equity or whatever, I'd like other people to lose money before I do in any given investment, right? Ideally, right? And so again, the casino operator, is just standing there waiting. Someone comes in and they've got their chips, right? Casino operator knows 92% of the slots, right? I win, or whatever the percentage is, right? 58% of the blackjack hands I deal, I win, right? So I just keep dealing and dealing and dealing, but the odds are in my favor. And so in our case, when we have a portfolio of investments where on average there's 30 or 35% subordination, there's value underneath us, real checks being written that needs to be eviscerated before our value is touched. That gives us real margin of safety. And so we're really focused on that notion of, where we are in the risk stack. There's a continuum of risk reward in any given investment we're at. So you combine those two things, and, hopefully it's going to be really hard to lose money. Still not impossible, but we want to be the last man standing if possible.
What does the future hold for Arena?
Well, we've got a ton of wood to chop. We're working on building on all of those things. We're hiring quite a few people in our operations area, in Jacksonville, and in a new place we're opening in India. We're building our processes and our IT better and better and better. And, we're adding more and more joint ventures. We've really planted our flag sufficiently for now in our main kind of theaters of operation: North America, Europe, Asia Pacific, and Latin America, right? So we have that base platform, but there's a lot of building to do, and we're working very, very hard because we see this opportunity coming in the environment that's going to be unfolding over the next many years, and we want to build an infrastructure and an enterprise that can most benefit from that environment.
Dan, it's absolutely fascinating. If folks want to follow along with what you're doing or get in touch with you, do you have any suggestions how they might go about doing that?
Well, we do have we are partners with a public company in Toronto called Westaim Corporation, which trades on the TSX. So Westaim has a very developed website, as do we. And we effectively report quarterly. We have sell side research coverage, and we try to be in touch with thoughts, to shareholders to hopefully communicate our vision to them, as well as the investors in our funds. So there's a decent amount out there.
Well, that's fantastic. Dan Zwirn, Arena Investors, thank you very much for your time.
You're welcome. Thanks for having me.